Picture your last payslip. Now imagine that exact number landing in your account every year, forever, without you ever clocking in again. $85,000 a year. That's the number we're chasing today. It's enough to cover a mortgage, run a car, take a holiday, and still save something. Most Australians think you need one specific number to get there. You don't. You need a path. And there are 6 of them, from the safest option in the country to the boldest. Stick with me, because path number 5 is the one almost nobody talks about, and it's the one that actually gets most people there fastest. Let's start safe. Government bonds. In 2026, Australian 10-year government bonds pay around 4.9%. That's about as close to risk-free as money gets in this country. To live off $85,000 in bond interest, you'd need $1.74 million sitting there, quietly earning. Sounds simple. Here's the catch nobody mentions. Bond interest gets taxed at your full marginal rate. No franking credits. No discount. Nothing. If you're sitting in the 37% bracket, that $85,000 target actually means you need closer to $2.4 million, not $1.74 million. And inflation doesn't pause for your bond portfolio. The $85,000 you live on today buys noticeably less in 20 years, while your capital sits frozen at the same value. Safe on paper, slowly losing in real life. Path 2. Dividends, the Australian way. This is the one most Aussies fall in love with because of something almost unique to us, franking credits. When an Australian company pays you a dividend, it's already paid 30% tax on that profit. The government hands that tax credit back to you. The ASX 200 average yield sits around 3.5 to 3.8%. High-yield ETFs like VHY push closer to 6.5 to 7.5% once franking is added back in. To pull $85,000 a year in fully franked dividends, you're looking at somewhere between $1.20 and $1.6 million invested. Sounds great. Until 2020 happens again. The Big Four banks slashed dividends almost overnight that year. People who built their entire retirement plan around CBA and Westpac watched their income get cut in half with zero warning. One company can fail you. A spread of 50 to 100 companies almost never does. Here's what most people miss, though. The ASX is heavy on banks and miners. When those two sectors sneeze, your safe dividend income catches the cold too. Path 3. The total return method. The 4% rule. This is what most financial independence planners in Australia actually build around. You hold a mix of Australian and global shares, then withdraw 4% of the total balance each year, adjusted for inflation. To get $85,000 this way, you need $2.125 million. Bigger number, smarter mechanics. You're not just living off dividends anymore. You're selling a small slice of a growing portfolio each year, so the whole thing keeps compounding even while it pays you. A common structure is 40% Australian shares for franking credits, 60% global shares for growth you can't get locally. Path 4. Aggressive growth. Higher risk, higher reward. The ASX has returned close to 9% a year over the long run, dividends included. If you can stomach a 20 to 30% drop in a bad year without panic selling, you can pull a higher withdrawal rate. 5%, even 6%. At 5%, you need $1.7 million. At 6%, just under $1.42 million. Smaller number. Big danger. Here's the trap almost nobody explains properly. It's called sequence of returns risk, and it has quietly destroyed more retirements than market crashes ever directly did. Picture retiring in late 2007 with $1.5 million. By March 2009, you're under $900,000 and you're still pulling $85,000 a year out of a shrinking pile. Many people in that exact position never recovered. Not because the market didn't eventually rebound, because they were forced to sell at the bottom just to live. The fix is almost embarrassingly simple, and most people skip it anyway. Hold 2 to 3 years of living costs in cash before you stop working. When markets fall, you spend the cash, not your shares. Your portfolio gets time to heal. Now here's path 5, the one most finance channels conveniently leave out. It's not an investment at all. It's a number. Your spending number. $85,000 sounds like the target, but what if it isn't actually your number? If you can build a genuinely good life on $60,000 a year, your target isn't $2 million anymore. It drops to $1.5 million. If your mortgage is paid off and your fixed costs are low, $50,000 might fully fund the life you actually want. That brings your number down to $1.25 million. That's a $750,000 gap, created entirely by adjusting your lifestyle, not your income. The fastest path to financial freedom in Australia has never been earning more. It's needing less while still living fully. The couple in a 10-year-old Corolla with a paid-off house in the suburbs is usually decades ahead of the couple leasing 2 SUVs in a postcode they can't actually afford. Wealth isn't what you earn, it's what you keep. And now path 6, the one that makes all 5 other paths happen faster. Superannuation. From the 1st of July, 2026, you can contribute up to $32,500 a year in a super at just 15% tax, instead of your normal marginal rate. If you're in your 30s and salary sacrifice an extra $500 to $1,000 a month, that single decision can add hundreds of thousands of dollars to your final balance by retirement. It's the closest thing to free money the tax office will ever hand you. Starting later, in your 40s or 50s, there's a carry-forward rule that lets you use and use contribution caps from the past 5 years, all in 1 year. Perfect for high-income catch-up years. So here's how it actually plays out from zero. If you're 30, investing $1,500 a month at 8% average returns, you hit $2 million by 60. Push that to $2,500 a month, and you arrive by 54. Push it to $3,500 a month, and you're free by 50. Time is almost all the work. Consistency does the rest. So here's what actually matters out of everything you just heard. Pick one path. Bonds, dividends, total return, aggressive growth, or the quiet 6th lever of lowering what you actually need. Work backward from your number. Work out the monthly amount. Automate it. Then stop checking the balance every single week. Because the Australians who actually hit financial freedom aren't the smartest investors in the room. They're the most boring ones. They pick a plan, automate it, and ignore the noise for 20 years straight. If this gave you a real plan instead of just a number, hit the like button. If you're not subscribed yet, now's the time. And turn on notifications so you don't miss the next one. I'll see you there.